The real estate market is going to crash at some point. It seems that every single year somebody somewhere is saying that the market is going to crash. Eventually they're going to be right. In hindsight, a crash always seems obvious, but in the moment it can be a little hard to tell. It's pretty much inevitable that the market is going to crash, but I don't see much point in trying to predict it. I'm more concerned with what we can do to protect ourselves when the market crashes rather than trying to predict whether it will in the first place. In this video, I'm going to be going over some of the costly mistakes to avoid so that when the market does crash, we not only don't lose money, we can actually gain money. If you're interested and want to reach out to me and talk more about real estate in general, I'm going to leave my contact info down in the description. You can either just send me an email or you can DM me on Instagram. The first thing that's important to keep in mind is sound investing principles. Things like invest for long-term growth as opposed to short-term. This will allow you to grow your money over the long term while being almost indifferent to short-term fluctuations. So with that in mind, you want to make sure that you never invest money that you need in the short term. Whenever you invest, you always run the risk that the market could crash immediately after you buy something, and you have to understand that this is a risk and you have to be fine with it. If you need that money to pay your mortgage next month or to pay for your kids' education, then you could be putting yourself in a pretty bad situation if you're investing that money. You're not really going to gain much either. There's not really much opportunity cost to not investing that money, because even if you did invest it, you probably wouldn't be gaining a whole lot during that short period of time anyways. Over the long term, yes, you will gain a lot of money, but short term, not so much. You can actually lose money. If you're buying on the basis of intrinsic value, that something has value or it will have value to somebody, or you can add more value to it, then it will go up over time. If you're buying on the basis of some new fad and like everybody's buying it, like say, I think a lot of NFTs are like that. Not all of them. I'm not trying to bash NFTs, but I think a lot of them are valueless, and it's just people buying into it because of the fad of buying NFTs and it's cool now. Another one that's important, and this one is more real estate specific, is that location matters more than condition. If the neighborhood's bad, it doesn't matter how nice the house is, people still don't really want to live there. But if it's a good neighborhood, you can always fix it up and add more value to it and then sell it at a higher price later on. Another good investing principle is dollar cost averaging, which is where you essentially invest the same amount on a regular basis regardless of what the price is. So say for example, if I'm investing in stocks and I have $300 every month left over after all my expenses are paid, say if I like a particular stock, I'm going to buy $300 worth of that stock. So say if it's worth $100 a share, I'm going to buy 3 shares. Now let's say the share has jumped 50%, it's gone way up, and now it's worth $150 a share. Now I'm going to buy only 2 shares. I'm not going to buy an additional 3rd share because that would be spending more money than I have allocated to that stock. And just like on the flip side, if it goes down in value, now it's only worth $50 a share, I'm now going to buy 6 shares of the same stock, but I'm investing the same $300 regardless of what the stock is doing. And this leads me into my next point, which is market psychology. There are certain things that we as humans are susceptible to, and having an understanding of market psychology can really help us to avoid some of that. A lot of people tend to buy when the market is going up out of fear of missing out. And then a lot of people tend to sell when the market is going down out of fear that it's going to go down even further. Basically, they're doing the opposite of good investing. They're buying high and they're selling low, and that's the number one way you lose money with investing. If you're watching your portfolio plummet in value and you're wondering if it's going to continue going down further, it's important to remember that you only lose money when you sell. A lot of people try to sell out at this point and try to cut their losses because they're convinced it's going to keep going down further. And that might be true. It might have gone down 20%, and maybe it falls another 20% before we hit the bottom. Who knows? It's kind of hard to tell, and it's really hard to predict that sort of thing. Remember, like I said before, you have to be prepared to watch your portfolio lose 50% or more of its value. Dollar cost averaging is a good way to avoid some of that. Like if the market's going up and everything's gaining value, you only invest the same amount regardless of what the investment is doing. Now that can either be a percentage of your income or it can be a set dollar amount, but try to keep that number relatively consistent. One reason I like real estate is that it can actually help you to avoid some of the impulsivity of buying when things are going up and selling when things are going down. The reason why is that it can be pretty difficult to buy and sell a property. If you want to sell your property, there's a lot of steps you have to do. You have to call your real estate agent, you have to try to find a buyer, and the process can take weeks, maybe even months in some cases, especially if the market is tanking. There's a lot of opportunities to think twice about what you're doing in that period. But with something like stocks, for example, I can just sign into my Wealthsimple account and sell off my entire portfolio in a couple of minutes. And before I even realize what happened, the damage is done. Real estate being difficult to buy and sell can be both a blessing and a curse because it eliminates some of the impulsivity that can come with other investment choices, right? If everybody's telling you to buy this hot stock, you might be tempted to buy into it. But with real estate, it's a little bit harder to do that. Not impossible, people can still do it, but it adds a little bit of an extra barrier to that. It's important that no matter what you do, you do not sell. If you have to, sell some of your furniture first before you sell those investments. With that being said, market crashes can actually be an excellent opportunity. If you've been trying to get into the housing market over the past 2 years, it's been next to impossible. A lot of people are like just waiting for prices to go down. And currently we have seen a bit of a correction where there's now more inventory on the market and prices have gone down a little bit. I still see a lot of people very hesitant about this because they're waiting for it to go down even more. If prices drop 20% and you're like, I don't know if I want to buy in, maybe I'm gonna wait for them to drop a little bit more. But even if you bought in at a 20% price drop and then it goes down even another 5-10%, you still got a 20% discount on that investment. It will go up over time, but now you actually have your foot in the door. So when the market crashes, everything is on sale and people will always need houses. Just because it's not looking too good, people will still need to either buy or rent a place. So if you own a property, it will always have some value. I think it's important to always have a little bit of cash on hand just so that you can pay any emergency expenses that come up. But also if the market does crash or things lose quite a bit of value, you are actually in a position to capitalize on that. Everyone always talks about how lucky people were to have bought during 2008 when you could buy up an entire neighborhood for like a pack of gum. When we're in a similar situation, everybody's always hesitant to buy. So you want to learn from that. Who cares if it drops further? Because again, it will go up over time. If you buy intelligently on the basis of sound investing principles, you will come out on top. Now you might be wondering, what about if I already have a property and it's gone down in value and now I'm underwater on my mortgage? What do I do? Well, if you're an investor, you want to be able to get positive cash flow, even if it's only a couple dollars. You want to be in the green, whereas like if you rent out that property, it will at least at the very minimum break even. So if it's costing me $3,000 a month, I want it to be generating at least $3,000 a month. This will allow you to hold on to the property long term as long as it's not costing you money. If you're losing $1,000 every single month that you hold that property, it's going to be kind of hard to wait a couple of years to be able to sell it at a profit, right? Because you're just bleeding slowly. Now that being said, if you already have a property and you can't rent it out, you can't get positive cash flow on it for whatever reason, you can always fix it up and add additional value to it. This will allow you to increase the rent you charge for it, so you might be able to get positive cash flow from that, or you'll be able to sell it at a higher price. Now the next question you might be asking is, what if rents go down? What if the market rent for that area goes down in value and you're not able to rent it out for as much money? Typically when the market crashes, rents actually stay stable or go up. And the reason for this is because like I said before, when the market crashes, people get hesitant and they don't really want to buy a house, but people still need to live somewhere, so they move to renting instead. They'll go, you know what, I'm gonna rent for a few years and then maybe once things bounce back and the market isn't looking as bleak, then I'll buy in again. Now on the flip side, it's kind of weird. Rents also tend to go up when prices are high because people can't afford to buy houses and therefore are forced to rent because again, they still need to live somewhere. The only time that rents tend to fall is when the market is coming out of a recession and is starting to gain value. Rents will typically start to fall because people will now start to move from renting to buying. There's an old saying which is, don't wait to buy real estate and wait. It's important to remember that regardless of what the market does, if it crashes or doesn't crash, never stop investing. You might need to change your strategy, right? Don't stick with the same thing, especially if it's not working. Maybe you had a bunch of rental properties and you decide you want to now move into flipping houses instead. That's totally fine. Just don't stop investing, okay? You have to continually be investing your money and growing it over time. You might have to change the way you go about it, but do not decide to stop and just buy in maybe once things get a little bit better. Keep investing consistently over time. You will make money, right? You might see a lot of videos on YouTube with flames in the thumbnail. This is gonna look so cool. Telling you that now is not a good time to be buying real estate or any other investment for that matter. But it's always a good time to invest. It just, your strategy might have to change slightly. Now, just remember that none of this is financial advice. I'm just some random guy on the internet. You have to make sure that you are properly researching any investment decisions you make, and you and only you are responsible for those decisions. So in summary, you want to keep in mind sound investing principles. You also want to keep in mind market psychology and be prepared to watch your portfolio lose 50% of its value or more. Also keep in mind that market crashes are an excellent opportunity. So if you like this video and you want to talk more about real estate, I'm going to leave my contact info down in the description below, and don't forget to like and subscribe. I'll see you in the next one.